Welcome back to Value Stack. It's been a little while. As you can see, we've upgraded our set.
Bull
And our
market.
guests. Bull market time. Yeah, I think last time recorded it was like February, so we're like 30, 40K. We're at 60 now. If you're not familiar, this is Jameson Lopp. He's a Bitcoiner. Would you describe yourself as a Bitcoiner?
Cypherpunk.
Cypherpunk.
Bitcoiner. Nerd.
What are we gonna want to talk about in this episode? You said that there were some interesting things going on, both on Bitcoin mainnet, but also on Bitcoin Testnet.
Yeah, I mean, there's a lot of stuff. We could talk about technical developments. We could talk about my attack on Testnet. We could talk about a variety of government attacks that are happening just in the past week.
I love that. So let's use this theme as the attacks. There's attacks on us from everywhere, and maybe you're participating in some of them. Let's start with Testnet. So you were explaining yesterday to me that the Testnet needs to be reset. Can you give me an idea, just a short summary of why that is and how you came to that conclusion about it as well?
Sure. So what is Test Network? It is a network that is not Bitcoin. It is separate from Bitcoin, but it is almost exactly the same as the Bitcoin protocol. And the entire premise of Testnet is to have a network that is basically exactly like Bitcoin, but that has no value. So, we want developers to be able to experiment and build and innovate and do stuff on Bitcoin without having to pay for the privilege of doing so, and to be able to do so and take risks, without having to potentially lose a lot of money. So one of the problems that has compounded as a result of several other things is that now Testnet is in a state where Testnet Bitcoin is scarce, it is very hard to get, and as a result, it has accrued value, and there are actual markets where people are buying and selling these Testnet coins. That's not great for developers. You shouldn't have developers needing to go out and buy these other tokens.
So let me ask you, how did we get here where Testnet tokens became so scarce to where they eventually started becoming valuable in some people's eyes? How did that concentration and allocation happen?
So, at the moment, Testnet is at block height 2.6 million something, which is equivalent to the year 2057 if we were thinking in mainnet terms, in terms of assuming 10-minute block times or so on. And the reason that we are at that block height is that there are some eccentricities to Testnet that allow you to create blocks at a very low difficulty. And this is basically just to ensure that blocks are continually coming into Testnet.
So you can test, right?
And but that combined with what you could call a bug or an assumption in the difficulty adjustment logic means that every once in a while, the mining difficulty on Testnet gets permanently reset to the minimum level of 1. And this creates a phenomenon that I termed block storms back in 2015 or so, which is basically you end up having 10 to 20,000 blocks get produced in a single day.
When's the last time that's happened?
Well, it's funny you should ask. Normally, that happens at I did some number crunching on the Testnet blockchain. Normally, that only happens 12% of the difficulty adjustments, which is, I think, twice a year under normal conditions. And the reason for the 12% is that the minimum difficulty mining rule on Testnet requires that you go 20 minutes without mining a block. And if you look at the Poisson distribution of mining a block, then around 12% of blocks should take longer than 20 minutes. And so that means 12% of blocks on Testnet hit that rule, and therefore every once in a while, 12% of the difficulty adjustments happen to hit that same rule edge case. And this is where there's the assumption in the difficulty adjustment logic where it only looks at the difficulty target of the previous block, and it assumes that that was the difficulty target for the entire 2016
That's
blocks.
testnet only assumption.
No, that's on mainnet too, but that's a correct assumption on mainnet because mainnet doesn't have this weird rule that allows you to do low difficulty blocks.
Oh, I see.
But whenever that low difficulty block stuff got coded into the testnet, it was just overlooked, and this block storm phenomenon resulted. So as a result, the rewards for a block, I think, are like 0.1 or 0.01 testnet coins. So there's not a very good distribution of coins happening even to people who are mining on testnet these days. Contributes further to the scarcity. And also, it's been 13 years. We're currently on the third iteration of testnet, but we've been on it for 13 years. And so people have started to operate under the assumption, I think, that testnet is a decently stable platform that you can actually do stuff of real economic value on. And so I set out to prove them otherwise. Yeah.
And so do you think that this will be reset? And is this an inevitable? I mean, I looked at the mempool of the testnet blockchain, and it looks outrageous compared to the historical. So is this coordination of resetting testnet that you're in favor of? Is it succeeding in your view so far?
So I've essentially been griefing testnet by exploiting some of these edge case rules and flooding the network and triggering these conditions, just to make it annoying for some people who are too reliant upon testnet being like a stable network. And the whole idea behind that is just to hammer on the points of what I set out in my email to the development mailing list, in which I also said we should fix this weird edge case that causes block storms. So suffice to say that for the past week or so, Bitcoin testnet has been in a perpetual state of block storms because I'm running some scripts and some daemons that are triggering these block storms at every possible point.
The man who killed testnet right here.
I can't kill testnet, but I can make it very annoying to use. And so several of the projects essentially became unusable because their back-end infrastructure couldn't handle the deluge.
And so do you feel like there's, like any ethical reasons why you shouldn't do this or better, I'm sure you considered the ethical reasons why you shouldn't do this. Why did you ultimately decide that it was worth it, given that some people were valuing this at real money?
Yeah, sure. Some people
money.
have gotten very upset and said that I've been like tampering and destroying with their property or whatever. But this is crypto anarchy. I am following the rules of the network. It's not my fault that they're so ignorant that they didn't understand the rules.
And it's not like you are using this loophole or vulnerability to your financial gain. In fact, you're sounded the alarm about it so that testnet can become usable and better serve its purpose for developers, right? That's the whole point of it, was to reset it so it's not 0.01, and so that people who need it don't have to actually spend real value to.
Pretty much. I suspect that if I wanted to put enough time and effort in, I could probably find some weaknesses in some of these projects and try to get some sort of financial gain out of it. But I'm not at that point, and it's probably not like that much value that's actually occurring on there.
Do you think that, what's like a timeline of what we can expect or what you might guess?
I think the best case scenario is that we can basically get the next version of Bitcoin Core and other major client implementations out there to update their definition of testnet. So what do? Essentially, you have to mint a new Genesis block, and that gets hard-coded, into the client software. And so then when you start up your node and you pass it the testnet flag, it just joins this new network with this new Genesis block, and we essentially start over from scratch.
From every other perspective, it'll work like Bitcoin mainnet does today, although the subsidy will be different. I guess it's different now, right?
Yeah, well, the subsidy schedule is the same, and of course that's only based upon block height, how many blocks have happened on the network.
Are there any implementations in Bitcoin Testnet that don't exist in Bitcoin Core aside from the reset that you mentioned about the difficulty adjustment? Like, is it code for code, mirror or otherwise?
Yeah, as far as I'm aware, everything else is exactly the same. Transaction construction, all of the different features that have been soft forked in over the years.
And so and just to reiterate, the block storm vulnerability that was discovered, the difficulty adjustment, this was an intentional thing that was done initially to make sure that developers could get testnet coins distributed.
Well, the minimum difficulty rule was on purpose. What was unintentional, I think, was this edge case that caused the permanent difficulty reset edge case that is what I've been exploiting recently.
Okay.
But that's easy to fix. It's like a one-line code fix.
And so was the plan, like a path forward here, just to essentially reset the testnet with
and
new software and fix that line of code?
I think so.
And then start at 50? Why couldn't we start at, I guess is there probably a reason we couldn't start at the current block height? Because it would then.
Yeah, I mean, you have to start over from Genesis. Okay. And then, there have been people suggesting other changes on the developer mailing list thread, but ultimately it turns into a debate between, do we prefer to have testnet be different in this way because it's better for developers, or do we prefer for it to be as close as possible to the main network and then just instill an ethos of resetting the whole testnet more frequently to make sure that it doesn't accrue value. So I kind of have a thesis at this point that if a test network goes on long enough and is used and developed on long enough, it's probably inevitable that it will start to accrue value, especially if those tokens start to become scarce.
Yeah. Good point. Well, let's see. I think we hit that one enough. What about some of the other things going on mainnet right now? I mean, we just had the halving, and with that, the runes protocol is going on, and we saw, speaking of mining block storms, it was like the opposite. It was the only storm was the transaction fees that occurred. Mm-hmm. What do you think about the current state of hash rate mining health, and maybe Bitcoin as a result of that? Take it in any direction that you want.
Yeah, I mean, the hash rate and distribution amongst pools has been too centralized, I think, for a long time. So the bright side of what happened recently, I thought it was pretty cool that we went for 104 blocks straight in which we showed that fees were exceeding subsidy. Mm-hmm. So this is just an interesting proof that it is possible for the economics of block space to become sustainable, at least for a longer term than we've seen before. It's usually only been 1 or 2 blocks before. And so 104, that's 3/4 of a day. Right. Obviously, we want to get to a sort of perpetually sustainable state, but that may take another halving, or it may take just new use cases bringing more and more demand for block space to the network. Hash rate centralization is a tricky thing. I think what we've seen from people who have been analyzing, for example, the different block templates amongst different mining pools and actually looking at the flows of the Coinbase outputs, like the newly mined coins, and a lot of them seem to be going to the same custodian. There's some kind of fishy stuff going on there. I've also heard that a number of these mining pools are basically just fronts for Bitmain's Ant pool. So they're
operating under a different name, but
I think there's some further fishy stuff going on there. And I was actually at MIT Bitcoin Expo just a few days ago, and there was a mining panel, and I asked I think it was Galaxy and one of the other, like Hut 8, leaders on stage. And I asked them, why don't you run your own mining pool? The common reason that we usually hear of why people don't run their own mining pool or just mine solo is because of variance, right? Is if you have a really low percentage of global hash rate and you would basically never mint a block, then it doesn't make sense to do solo mining. But if you're one of these
that big,
yeah, if you're one of these big companies that has like a percentage, like 1% or more of the network hash rate, then you should be getting payouts daily, on average. Of course, there's still going to be a variance. That seems like low enough variance to me for a company, an enterprise, to be able to handle. But that was not the response that I got, and in fact, it was basically posed that the cost of outsourcing to a third-party mining pool is a rounding error for these big miners, and that they see it as, if we were running our own infrastructure, then that's going to be a bigger cost center, and we might screw it up, like we don't trust ourselves type of thing. I think someone brought up separately in a different conversation that I think Marathon does run their own mining pool, and I think there have been 1 or 2 incidents where they screwed up and like mined an invalid block, and that probably cost them far more than it would have if they had outsourced to a third party. So it's an interesting, I guess, risk analysis and cost analysis for these miners, which is, it's not great. Potentially a way of mitigating that would be if we could get more of these mining pools to update to use Stratum v2. So for me, the problem is not so much that you're just outsourcing to a third-party miner. It kind of makes sense that these pools are specializing in running the software. So I've been learning more about running pool software as a result of my testnet attacks, because I have some potential other future plans there. And it's actually, it was not, even for like uber Bitcoin nerd like me, it has not been easy to get a Stratum server up and running. I've tried like 3 different Stratum server software options and couldn't even get them to work. And then I've started playing around with some of the Stratum v2 stuff and been able to get it to work for like a minute or 2 before stuff crashes. So I can understand why it could be a pain to run your own Stratum pool if you're not dedicating resources to this. So coming back around to like what is the actual problem, the real problem is that you're outsourcing the block template generation.
Is this a new source of revenue for miners? I know Mara's pool's been doing some stuff like that.
Well, you're hoping that the miner is smart enough to optimize what transactions they're selecting from the mempool, and that's usually pretty straightforward. Though some people are getting more sophisticated in their strategies for mempool transaction selection. But there's a couple of risks that I'm not sure that these big companies are really thinking about. So first of all, there's a custodial risk, because the Coinbase output is not going to be going to your wallet. It's going to be going to a wallet owned by the pool. And then, you have to wait 100 blocks for it to mature. And then hopefully it gets moved, to an address that you can control. Another thing that might be more concerning, because it's less obvious and it's probably even harder to prove, is that if you have a third party that is generating the block template, they could be accepting out-of-band transaction fees and not passing those along to you. So, they could be adding a bunch of transactions into a block that are actually paying fairly low fees on chain, and then they're getting paid via some other method.
So the person who's mining to the pool is not getting their share. Their pool, the pool operator is getting all of that, what they're getting paid out of band.
Yeah, and you wouldn't be able to know that you're getting ripped off because those fees aren't showing up in the block.
Wow. Okay. And is that something fairly new that it didn't exist some time ago?
Oh, it has existed for a long time. I think it's just become more
common practice.
Yeah, like I know that at least as early as I was like working full time in the industry back in 2015, there were pools that had private APIs that you could push transactions to, and sometimes there would be out of band fees required. Sometimes it was just basically doing a favor.
Is this just happening and people are caring about it now because of ordinals, and there's this application and significantly more value in doing like a block template templating in a certain way? Is that why people are all of a sudden concerned about this? Why is it part of the conversation on Twitter and all now?
I'm sure it's a variety of reasons. Though one of the more common ones for doing the out of band stuff is people who are pushing non-standard transactions. So people who are doing
that increasing.
It seems to be. It's just like there's more people experimenting with what you might call meta protocols or inscriptions that are too complex to be relayed through the Bitcoin network because the default node policies would reject them and not pass them on.
Mm-hmm. What about the some of the BIPs that have been recently assigned new numbers like OPCat, TX hash verify? How do you see those fitting in? Do you think I know at least in the case of OPCat, it existed at one point. What's your stance on that? And can you help explain to someone who maybe understands Bitcoin but isn't a developer, like how these might impact a user if they are or are not approved and ushered in?
Yeah, these are fairly new developments. Like it's just nice to see more discussion happening about actual like base protocol level improvements. Some people are very afraid of any base protocol changes. Yeah. They're afraid of unknown unknowns. But as I've said a number of times, like there's unknown unknowns to making changes to the protocol, then there's unknown unknowns to not making changes to the protocol. So I don't really see that as a strong argument. Rather, we just need to be very conservative and thoroughly evaluate all of these proposals to understand what risks, what trade-offs there are. And I haven't dove extremely deep into all these different proposals, but the ones that are most interesting to me are those that can enable sidechain development and second layer development, basically to improve the ability for us to finally be able to do permissionless two-way pegs between the base chain and second layer networks.
Are you referencing ARC in that example? I know it requires or benefits from.
Yeah, I mean, it seems like a lot of these second layer proposals that are out there, whether it's ARC or BitVM,
right.
I think even Lightning, like it seems like almost every layer 2 proposal can benefit from some of these different potential soft fork and like new opcodes. But it's really complicated as to like which ones benefit from which ones, like what the trade-offs are.
Sure.
But I think we just need to keep talking about it and get more people experimenting, on testnets or signets to actually, figure out, what are we able to do with these opcodes and are they safe? So OPCat is an interesting one because it existed in the version 0.1 original Bitcoin release, and along with a number of other opcodes, it got disabled because it was determined that there was some edge case where it was problematic and like some machines did not evaluate it the same as other machines. So, potential consensus failure problems.
Yeah. Okay.
But if I recall correctly, I think OPCat got re-enabled on Bitcoin Cash a few years ago. And as far as I'm aware, like nothing terrible has resulted from that.
Yeah. It just existing in itself, it doesn't need anything to hurt it.
So I don't know if someone thinks there's something terrible about OPCat, maybe they should go destroy Bitcoin Cash to prove to us.
Is this your next battle?
I don't know. We'll see.
Well, they're trying to destroy Americans' ability to save and earn a living, and I know Canada also increased their capital gains tax, and there's some proposals that came out this week from the Biden administration about the long-term capital gains, basically,
and unrealized capital gains.
Unrealized and
the really crazy one.
Yeah, so I think it was like if you have $1 million in income over the year, your long-term is considered short-term, basically, or something like that.
Great.
And then the rate, and then you go state tax on top of that, and then the unrealized gains. And they did say the unrealized gains portion would be assessed towards future realized gains deductions. But just remember that, every year the money's worth less. So your, deduction is also worth less. Remember that because they're nominal, right? What do you think about like what's going on with America? Like we had, at one point we had in the beginning of the year, a few months ago, we had the Bitcoin ETF and everybody's kind of like, oh, we finally made it. We're legit. And then now regulate me harder, daddy. Right. And that's what I think we're starting to see now is the other side of it. Like people are sort of like, wait a second, like the government is actually, they're not just going to let this go fly by night. What's your take on what's going on about the?
We're seeing so many privacy crackdowns.
Samurai is another thing.
Yeah, both inside and outside of crypto ecosystem stuff, right?
Sure.
So just a month or so ago, I published an essay about the Corporate Transparency Act, which was passed in I think 2020 or 2021 with the National Defense Authorization Bill. And basically that's stripping away a lot of the privacy that is afforded to us through corporations, which is something that myself and I suspect many other people in America use to help protect the privacy of their assets. Basically, you set up a corporation such that the true owners of the corporation are not publicly listed, and then you use that corporation to purchase real assets, aka real estate, vehicles, things that have to be publicly registered and create public records of ownership. And so FinCEN is basically starting to require that all of these corporations file paperwork with FinCEN to report all of those non-public owners. And as far as I can tell, all this information is just going into FinCEN's database, and it's getting shared with a whole lot of people. And of course, anything that's in a database over a long enough period of time usually tends to get hacked and leaked. Right. So I've been talking to a number of different attorneys and other people who are in similar situations to try to figure out what we can do to try to forestall this, because there was actually already a legal challenge to it in which the federal judge, I think in Alabama, stated that this was an unconstitutional law. Unfortunately, the result of that judgment only applied to the 200,000 businesses that were part of this trade association that sued FinCEN or Department of Treasury or whatever. And so that's weird.
Else.
It's like everybody else. FinCEN has said that it's still going to move forward with enforcing this unconstitutional law. So I'm trying to figure out, how do we challenge this in such a way that it actually applies to all businesses in America? Because there's, I want to say, millions of corporations that are going to be subject to this.
This is the BOI, Beneficial Ownership Interest document.
Yeah.
Yeah, I saw that when we were founding the space. That was something that we had to do. Was list it, list the actual end ownership, even if it was just a nonprofit entity or for profit, didn't matter. So there's an attack on our privacy. I think there's some sort of attack on our livelihood. We're getting unrealized. Talk about the unrealized unrealized taxation and how that is a form of penalty through government inflation. It's not even real gains, right? It's just penalizing for
yeah, that's
alive.
tough. I'm skeptical that will become a thing, because I just don't think it's feasible to require paying taxes on unrealized gains, because unrealized gains usually are highly illiquid.
Right.
It's if you can't even liquidate the asset to pay the tax,
but
I don't see how that's...
The nihilism is that's the point. They don't care. They just want to put you in a pickle so you own nothing and you're happy.
Yeah, so I mean, that would result, I think, in some crazy stuff happening in the stock market, for example. If founders and C-levels of companies that own massive amounts of equity in their companies are forced to sell, like 25% of it, that would have some massive ripple effects on Wall Street. So that's like one reason why I don't think it would happen, is because there's so much money and power there that is going to resist and is going to put up legal battles that I seriously doubt it's going to happen. And if it did, it would be so terrible. Like, the fallout is going to be crazy.
Yeah. So you don't think it will, even if it did get ushered in, it's going to be hell if they're going to get held back?
Yeah, but so for, once you start looking into wealth management, one of the best kind of advice that I've come across from all of the different books and stuff I've read is that, due to the nature of taxation of capital gains of assets, the way that you preserve long-term wealth and that you end up being successful is by not selling.
Hodl.
Yeah, and this is like not just for Bitcoin, like I said, this is for equities, real estate, like as many assets as possible, because every time you sell an asset, if you're going to trade it for something else,
it's a haircut.
Yeah, you're taking that hit. So if you're frequently trading, you're constantly taking hits on those capital gains. And so the institution of an unrealized capital gain tax would just totally change the game of how people think about
to hold
investing.
anything long anymore.
Yeah.
That's what they're doing with the long-term and short-term being the same too, where if you're over $1 million income, your long-term is short-term.
Yeah.
Which then it's subject to, if it's ordinary income, it's also subject to FICA, Social Security, Medicare, state income tax.
Yeah, so these type of things, I think it's part of the sovereign individual thesis that all you're really going to do, you're trying to squeeze blood from a stone, but what's going to happen? I forget the exact saying, but the more strongly you try to grip it, like the more the sand will come through their fingers or whatever. So basically, this is only going to hurt the people on the lower end of the wealth spectrum, the people for whom it is designed to extract the most value from. They're just going to say, screw you, I'm going to a different country. They're the ones who have so much wealth. They have the mobility to change residency. And this is essentially the sovereign individual thesis, which is, sure, countries can do that and they can try to gain more revenue through taxation, but this is a free market at the nation state level. So other countries are going to take the opposite approach and they're going to say, you know what? We're going to offer you incredibly favorable tax rates in order to get you to bring all of your capital over here. And as a result, they're going to start generating a lot more wealth and more capital in that tax favorable jurisdiction. So it'll be interesting to see how it plays out. I feel like even this proposal is kind of last gasp of a dying empire type of thing.
It seems desperate.
You could probably go back in history and see, similar examples in other empires that were kind of at their peak, and then they started realizing that they had taken on too much debt and they were struggling to increase revenue when what they really should have been doing was decrease spending. But it seems like from a sort of government and bureaucracy perspective, decreasing spending is always a less tenable proposition.
Right. Yeah, you mentioned the sovereign individual in the fourth turning. They talk about too how these cycles like repeat themselves. He's got the new book. The fourth turning's here. Would you say we're sort of in that precipice or getting close? And
yes.
How do you navigate what do you use as like your guide and where we are in that hyperinflationary last gasp for air? Like, how do you know we're getting there, and when we get through it.
Yeah, it seems like it, but we don't know if it's going to be next year, 5 years, 10 years,
More
20
based
years.
on actions and behaviors and events, things that happen, than time that's passed necessarily, right?
Right. So we can see the general trajectory, and the best you can do, I think, is to prepare for some of these worst case scenarios. I mean, it's all prepping of some sort, right? Whether it's financial prepping or survivalist prepping.
Prepper prepping. Yeah, it's a halving year. I mean, there's been a lot of excitement leading up to the first quarter of the year, and the price obviously went kind of crazy. Got the ETF approval. It seems like we're in this sort of post-high waking back up with a hangover, being like, oh yeah, there's some problems going on, from a both a code perspective to a privacy perspective, with stuff that happened with Samurai and FinCEN earlier this year, from a squeezing our cost of living out from inflationary perspective and interest rates. And so, I mean, shoot, it's you didn't think this was going to be easy, did you, Manon? So yeah, man, I don't really have much else to cover. I just kind of wanted to do an update with you. Anything else you want to wrap up, leave us with?
No, I mean, it seems like every government agency is going to define Bitcoin however it suits them most to have the greatest claim of jurisdiction over it, right? So like you'll hear one case from the Department of Justice or the FBI or whatever, and it'll be talking about Bitcoin money laundering. But then you'll hear something else from like the CFTC or the SEC, and it'll be like, no, it's not money, it's an asset.
And therefore we can tax unrealized gains on it.
Yeah.
So it's like whatever narrative suits them best at that moment, and that depending on which government and which agenda they're trying to carry out at that time will be how they'll use their political rhetoric to fit their narrative.
Yeah, and like the IRS has started putting more and more questions, it seems, into their forms.
I saw that.
And I don't know. I would suggest that you be honest when filling out your IRS forms, because you don't want it to come back and bite you in the ass, especially if you have poor privacy practices, because we've seen that the IRS has no problem doing John Doe summons, like requests, basically, to extract as much information from centralized custodians as possible.
Yeah. Got to stay alert, stay vigilant. Jameson Lopp, thank you for sharing your knowledge, and hit that subscribe button. We'll see you next time.
See you soon.